Hi, and welcome to the quarterly market update with Morton Brown Family Wealth. I'm Dennis Morton here with my partner, Katie Brown. Katie, good morning. How are you doing?
Hi, good morning. I'm doing well. How are you?
Good. So we're excited to have everyone here this morning. Looks like we have a lot of familiar faces here and some new ones as well. So just want to let you know how we operate on these half an hour sessions where we update you on what's been happening in the markets. This is interactive. We're going to be talking about a lot of material, a lot of what's been happening in the markets and for investors in the recent months. But we want you to ask questions too. So there's a live chat here. If you'd like to post a question, have us answer something, feel free to put it in the chat at any point, and we'll do our best to answer it as best we can from our perspective. So by way of introduction, Katie, for those who might not know who we are, what we do, could you give a kind of brief intro to the firm?
Sure. So Morton Brown Family Wealth, we are a fully independent registered investment advisory firm where it's our vision to build a community of clients and professionals leading purposeful lives through the stewardship of wealth. We work with families that want to be intentional with their wealth. And our advisory team, we are certified financial planners, which means, of course, we're going to talk about investments today in the portfolio, but our expertise also goes into things like retirement planning, estate planning, taxation, cash flow, all the things that kind of make up, your financial world. And so I mentioned today we're going to talk about investments. Dennis, why don't you share a little bit about why we're talking about what we're talking about?
Yeah, so I think a lot of times people in our profession get pigeonholed into the investment management space. I was listening to a couple of podcasts recently where they were talking about just the commoditization of investment management. We've all seen costs of investing being driven down. Credit to Jack Bogle at Vanguard for really driving down the cost of investing and making it more accessible for people. But truthfully, access to the markets is as easy as it's ever been. The real value of a firm like ours and people in our profession is to put investment into context. So today, I want you to think not so much about investment management as if this is a call to action that you need to dive into one place or dive out of another. This is building awareness and helping to really inform some of the inputs that are going to influence your financial plan. So when we create a financial plan for a family, there are certain things we assume. We assume there's a certain amount of income that we can earn based on interest rates. There's a certain rate of growth that we're going to earn on our growth-oriented investments. There's a certain amount of inflation. All of these things are top of mind for people right now. And that's why we want to build awareness and talk through what's changed, what's different, and how does this play into just all of the inputs that create a stable financial plan in the long term. Is that fair?
Sounds good to me.
Good. All right. So let's dive into some of the materials here. And realistically, for people, we tend to be optimists, not Pollyannish, but just we tend to be optimistic about the long-term view of things. This has been a tough first half of the year. There's just we talked about it in the first quarter. I think when we last met for this session, it was in early April. The market had been down pretty sharply in March, but bounced back a little bit. So we were kind of mid-single digits to the negative. Now things have really kind of capitulated, maybe down, 20% on the stock market and everything else. So it feels pretty dark. We're going to talk through about what the implications are and how you should be thinking about the plan. So let's dive into some of our materials here. First, we always like to start with some positive signals and reasons for concern. The economy is still in pretty good shape, isn't it, Katie? That's the anomaly here. Isn't this, it's just a weird thing to have unemployment where it is, kind of just people spending the way they are, but still seeing negative news, right?
Yes, that is, it is very unique when you look at the markets and activities and even consumer sentiment. We're going to talk about that a little bit too, but what's happening on one side of the equation is not necessarily happening on the other side of the equation. So that is a positive that there are still jobs out there. Not the unemployment rate at 3.6%. I mean, that is one of the Federal Reserve's mandate is to keep that unemployment number low and keep Americans employed.
Yeah, I think if you're going to have a negative event, rising interest rates, the Fed raising interest rates is kind of a negative event, has negative implications for the market. If that's going to happen, better that it comes where there's some strength already in the employment markets and everything else. I even went back, we were talking the other day about this idea of a jobless recovery. Coming out of the great financial crisis, there was a lot of talk about how it was a jobless recovery, that the employment rate was really slow to catch back up. So I went back and looked at, I think it was like 2013 or so, there was an article in Washington Post that said the last 3 recessions had jobless recoveries. That's going back to 1990, the dot-com bubble, and the Great Financial Crisis. So they all really lagged in jobless in employment catching up.
Mhm.
Now it's like a job full recession where we have, or if this does turn out to be a recession, a job full crisis of some form where things are negative, but employment rate remains high. So it's there aren't many parallels in our recent investing history. So the other positive, and this comes back to the financial plan, even more income available in fixed income. 10-year Treasury was at 2.98 at the end of Q2. It's hovering right around there right now. What are the implications for a financial plan, Katie?
Yeah, I mean, that has been the challenge for conservative investors to be able to earn any income on their fixed income in their plans. You really had to depend on that capital appreciation, that change in price of the bonds, which investors have benefited from. But when we think about, earning income or I'm going to say siphoning off some of those capital gains versus receiving interest or even dividends, the interest or dividends, that's the more typically historically the more stable, safer income. So as much as that bucket builds, that's better for investors going forward. So I think, through this term, we're going to talk about that too. It does help to lay the groundwork for some more stable income going forward.
Right,
So that is
right.
positive.
So then there's the reasons for concern. So this whole idea of a soft landing, when we talk about a soft landing, it's this idea that the Fed can enact a policy of higher interest rates and kind of getting out of crisis mode without inducing a recession. Those odds seem to be decreasing, but I think what's important to realize, and kind of the Fed learns with every new crisis, the lesson that they learned during the Great Financial Crisis was they didn't act boldly enough or quickly enough to abate, what was a rapidly developing crisis. That lesson applied during 2020 when, the pandemic hit and the Fed was very, very aggressive and seemingly, in hindsight, probably did a pretty good job of negating a lot of negative consequences coming out. But I think what we have to understand is the Fed's going to be very aggressive here because they don't want to get caught behind. They may already be behind, but that aggressive nature is kind of baked into their DNA right now. And that means that in the short term, not in the long term, in the short term, more volatility could happen.
Mm-hmm.
But the other thing that we have to understand is the Fed only controls so much. So there's sometimes, when it's policymakers, we're talking about the Fed or Congress or any kind of legislative body, they're pushing on a string. As much as they would like to influence certain things, certain things out of their control. So everything we're seeing in supply chain, whether China goes in and out of COVID lockdown, commodity prices, all of those are inputs that are out of the Fed's control.
Right. And it's not just us. It's across the global economy. I mean, a lot of places are slowing down. We're seeing that across the Eurozone. We're seeing that in many areas of the world. So that is another.
Yeah, you're right. Let's jump ahead. You're right. You just brought up, let's jump ahead to this slide because you talked about the kind of the nature of things. What does this tell us about kind of the global nature of one of our kind of negative inputs right now?
Yeah, there's a lot of focus on inflation and a lot of focus on, all right, what is the Fed doing about it? How do we manage this here in the U.S.? But it's not just us. We're feeling this across the world, and places throughout Europe are seeing inflation anywhere from 8 to 9% as well. And so this chart essentially looks at kind of year over year, that headline inflation, and we can see in the areas where it's like whiter and blue, not bad. We're kind of closer to targets, closer to low inflation. But then we start to see it spiking up, and you can see in 2021 and then in 2022 a lot of red. And so that's looking at both developed markets with higher inflation and also emerging markets with higher inflation. Some areas are holding up okay. Interestingly enough, China's inflation is actually pretty mild at about 2%. So we're seeing some divergence in areas, but like I said, if we look across the Eurozone for the most part, Germany and the UK, they're all kind of in a similar situation, and they're all in some respects kind of following suit to what the US is doing by raising rates as well. And so they're trying to get ahead of it as well.
Yeah, I always come back to there was a former chairman of the Federal Reserve, Janet Yellen, commented kind of late in her term that inflation was an enigma to the Fed. They've been trying to raise it. All this blue that you see in the middle here from 2009 through 2020, the Fed was actually trying to raise the rate of inflation. They had a target of 2% or so for the better part of a decade and could never quite get it there. It was always hovering in the 1.5% range and could never quite move that. I think the interesting part of this, again, bringing it back to the financial plan, is that for that decade that we're looking at, from 2009 to 2019, 2020, there were some really good returns in the stock market and really low rates of inflation. It was just a Goldilocks environment for those real returns, the returns that you get above inflation. So, there's a little bit of kind of catching up that's happening here, but it's just an interesting thing to see just how blue this chart is for how long, for a significant part of our recent experience. All right, so let's dive into, this is where the Fed target is. So, right around that 3% range here. Headline CPI goes up to 8.5. Katie, what does this chart tell you about just kind of where we stand on inflation?
We've looked at this chart before. So this is going back to 1972, and we can see, throughout the 70s and even in throughout the 70s primarily, we had high inflation, but even in the 80s, as it was kind of working its way down. And then once we got past that, once we got to the 90s and to really up until last year, we were below those historical averages. Like you said, for a long time, the Federal Reserve was working really hard to get up to even just 2% or higher. And so this is really the first spike that we've seen in a while, in a really long time, where inflation, and there's different types of inflation that are listed here. The headline is kind of everything in the soup mix. The core CPI, so that's the bright blue line, that core CPI, that pulls out like housing and energy. And so there's a little bit of a difference there. Or I'm sorry, housing and food and energy. And we can see some of those differences in there. And then the Federal Reserve, they look at the consumer consumption. They look at the individual consumption indicators as well. And but we're starting to see maybe I don't know if we're going to be rolling over here shortly. We're looking at some things that typically might show some indication of maybe we're topping out. What are your observations from this, Dennis?
Yeah, I think things are, we've mentioned some of our weekly conversations that things are moving so fast that it's hard to project out long term. Just the movement has been so quick. If you look at something like certain commodities have really fallen off a cliff just in the last couple of weeks and months. Things have retraced. And I think we can apply that to just about anything. There's so many stocks. We've seen oil spike up and spike down during this. I think it's really hard to project out and kind of use current status and say, all right, this is going to be the case 3-5 years from now. I think what we look at it is to say, what areas of that inflation affect us? And that brings us to this chart, which we kind of debuted last time we talked, and it breaks out some of those individual components. And so what you see on this chart here are everything from inflation, which is running at 9% rate through June. But what are the components of that? So you see the green is energy, the red, new and used cars, food at home is in purple. We have the other category, which is things like healthcare and services. We have shelter and restaurants and hotels and transportation, so leisure, and then shelter. And just how those have grown. I mean, look back to something like the shelter component back in March of 2021 here on the far side. Let me get my pointer here working. Back in March of 2021, just how small shelter was as a component of inflation and how that's grown here in the last couple of months. That's housing, that's rent, everything else. Same thing goes for, look at the growth in new and used vehicles here, and look at the decline. You see that compression already happening. So while inflation has crept up, the share that's eaten up by new and used vehicles is really changing. So there's this just fluid dynamic happening. What jumps out about this chart to you, Katie?
Well, you're right, areas of growth, but then also areas that we're seeing starting to shrink a little bit. So hopefully if we do get more of those semiconductor chips that, we'll see those new and used cars continue to shrink. And that goes into a lot of different areas as well, hopefully in the kind of other category, um, as some of those supply chain issues continue to work their way out. And we do have it, broken out between some of the things may be more sticky. As you mentioned, the shelter for a long time, there really weren't a lot of increases in some of those areas. So some of it may be a little bit of kind of catch up and may stick around a little bit longer. Um, but then things like, energy, obviously there's a lot of geopolitical impact influence that is increasing, the energy bucket. And so when we look at some of the things that are perhaps, at the top that might be a little bit more transitory, hopefully as um, things continue to normalize or hopefully settle out here in the shorter term, we'll see those top sections start to compress a little more.
Yeah, it's funny how this is all. A lot of this is in response to consumer demand, right? Like just
Mhm.
there was a lot of demand for new homes, a lot of demand for people changing jobs, demand for restaurants. All of that accordion effect was happening, and I think you're just going to see a lot of that playing out. There was a story in CNBC just the other day talking about builder sentiment, home builder sentiment, had the largest single month drop in the survey's 37-year history. So just massive. Well, actually, with the exception of April 2020. So if you look back over 37 years, the only time that home builders sentiment dropped further was when there was a global pandemic and everything shut down. That's just really extreme.
Mhm.
I think we're just for a little while here. When the markets go up as steeply as they did last year, I think we're all kind of settled in, and that's fine. But that's still an anomaly. We're still in this period where we're getting massive accordion effects through all sorts of inputs. Inflation being one, home building being another. So just be aware of that, and just not everything's going to impact you the same. We're just looking at how much some of these transitory items start coming back down, and how each
Mhm.
of these impact. So again, in talking with your planner, just which of these matter to you most. If you have a low interest rate mortgage, if you're locked into your home, the shelter costs really might be very static for you, and you're not participating in that. But other
And
areas,
actually could be a benefit because that could give you access if you needed it to, additional capital. I mean, if if your home value has gone up, and I'm not suggesting that people necessarily go out and do this, but it may actually give you access to more assets too, should you need it, So there's the flip side, I think, of that shelter increase.
yeah, yeah. I think it's we often talk in investing. You don't own all the things all the time. So if you see something on the
Mhm.
news and oh my gosh, there's a catastrophe happening in this particular investment, you don't own all of that all the time. And the same thing goes for inflation. You're not buying everything all the time.
Right.
Sometimes you're participating. Sometimes inflation, when the cost of your home, the price of your home is going up, yeah, you're exactly right. It's a positive development. So keeping that in context. All right, moving on from inflation, let's talk a little bit about the bond market. We've been leaning on the bond market a little bit. I think it's a little bit less understood aspect. By the way, if you have any questions, feel free to pop in the chat here. But this is global fixed income returns over the last 12 months in the quarter and year to date. So far, this has been a very bad year for bonds so far, historically bad year. But there are places where you're able to have some preservation happening. Short term, if you look over here on the left, you see kind of 1 to 5 year treasuries, municipal bonds. The shorter term your bonds are, the better you're holding up. The longer term, the less so. Katie,
Mhm.
what do you think about what's happening in the bond market right now?
Yeah, it it is a fascinating place, and you're right that the shorter term we're starting to see more preservation, and even in like getting out to like the 10-year treasury, that has been something that's been fascinating to watch as we've had higher inflation and more concerns about a potential recession coming up. We're starting to see that flight to safety where people are starting to go back to treasury bonds and putting their money there. And actually that's driving the yields down, which keeps the prices up. So we're starting to see some pockets of stability in bonds acting more as we expect bonds to act. I think some other areas, corporate bonds and municipal bonds in general have held up pretty well too, considering, the movement in rates that we've seen. And then the last thing in here is the one positive return over the last 12 months being that 1 to 5 year treasury inflation protected securities, those tips. You see they've eked out a little bit of positive return, and those are designed to help keep pace. They're not necessarily going to be you're not necessarily going to make money necessarily. I mean, I guess a little bit in this environment, but they're designed to help keep pace as inflation rises. And so they've held up fairly well also.
That's also an indication you have to get there early. The positive is only 12 months. If you waited until the beginning of the year to get into inflation protected securities, you have a negative return on that even there. So that's why that kind of steady allocation to those things. All right, let's show, we talked about this being a bad year for bonds. This chart shows the annual returns. The gray bar is the annual returns for the bond market going back to 1976. The red dots here are the inter-year lows. So for example, last year, the bond market finished down 2, but its low for the year was -4. Low for the year was -2 here in 2020. The high, we finished up 8%. Look at that number, Katie. That's a big down number. What does this chart tell you?
It is a big down number. Well, one is telling me we're still looking at a short period of time. We have 2 quarters under our belt, but it's been the worst 2 consecutive quarters in history. When we pull this back, so this is the Bloomberg Egg going back to 1976, as you mentioned. If we broke this down into quarterly returns, that tracking goes back to 1980. And so looking at the first 2 quarters of 2022, they line up with being the 3rd and 4th worst quarters ever. Unfortunately, they're back to back. And so, we have that big down year here. But I think, and I know this isn't 1980, but I think it's a strange, and it's not an apples to apples comparison by any means, because there are a lot of other things going on. But in 1980, if you look at 1980, the lowest it ever got at one point was down 9%, and then it actually ended up positive 3. Now, when it started, you had treasury yields at like 10%, and then it ended at 12%. Is very different from coming off of 0 that we have here. So it was a very different environment. But I think that we have seen that, just looking at this chart, the majority of the time it ends positive. Sometimes that recovery in bonds can be pretty swift, maybe even sometimes more swift than the recovery in stocks, which I think is interesting. What do you see there?
Well, I think I always think about what the catalyst is here, and there's 2 different ways that bonds can get hit. One is on credit quality. With a bond, you expect to lend your money out, get paid a rate of interest, and get your money back at the end. When you buy a bond fund, you own a collection of bonds, and your expectation is that those bonds, you're going to get your money back over time. One of the risks is, what if you don't get your money back from that company or that municipality or whatever it might be? We're not seeing credit risk right now. This isn't 2008, at least not at this point, where there's companies or municipalities that might be in jeopardy of not giving your money back. The other type of risk is duration risk, which means how sensitive are your bonds to rising interest rates? Higher interest rates mean lower bond prices. So right now, it's really just bonds that are longer term getting hit hard because of rising interest rates. So I would be more concerned if I was a bond investor if this was a credit issue. But right now, it's a duration. So our emphasis has always been on shorter term, higher quality, short and intermediate term bonds, higher quality. And we still have confidence that that snapback can happen because we're confident in getting our money back from a bond investment.
That's a really good point. Really good differentiation there.
All right, let's jump over to the equity markets here. So again, this is pretty similar directionally to what we had back at the end of the first quarter. The depth has changed here. So you're seeing kind of different, whether it's large cap, small cap, value or growth. Those are all the different sides and facets. You think of the high growth companies that have led the way for the better part of a decade, versus value. They're all down double digits during the second quarter. It's just a matter of degrees. And I guess I'll highlight here, the blue line here is large cap growth. Let's call that the NASDAQ as a proxy, down about 21%. And then you have large value, which has, 9%, outperformance over that time. Now, quarters are really short periods of time, but what we're looking for is, does this change the trend that we start getting the value stocks outperforming growth stocks? So, Katie, does anything jump out at you about this particular chart?
It's sad to look at.
Yeah, I agree.
I mean, you're right that the difference between value and growth, which is not surprising, I don't think, because in times of turbulence, oftentimes there's more comfort in, sticking with the companies that are, things that you need in your everyday life, which are often value oriented, utilities, energy, that type of stuff, versus the hot new technology item that maybe you don't need right now.
Right.
Anyway, so that's not too surprising. I think in something that's interesting, we've had this conversation with our strategist team over at East Bay, in that when we look at years, once again, going back to, just looking at my notes here, 1957. So going back a lot of years, in years where the markets were negative the first half of the year, it's literally a 50-50 split between ending up negative or ending up positive. So we don't know. I think it's the bottom line. And history tells us it could flip either way, that there's not a strong precedent for ending positive or ending negative either. So,
and I think, what that might speak to, and I'm just going to pull this out of my hat for a second, but if you own an index like the S&P 500 index or a broad equity index, in there you're going to have a combination of growth and value. And there's a constant, back and forth between leadership in those. So some of those years, and 50% of those years, the things that, drove you down are the things that bounce back. Sometimes there's a change. There's they jockey for position, so to speak. And the difference between value and growth, it's this idea of, sometimes you have to decide whether you're buying all the upside of a stock, with the risk being that you pay too much. And that's the Netflix story, right? Like, we'll pay anything for their earnings. And then suddenly we realize, oh, wait a minute, that was too much, and the stock falls off a cliff. Value, on the other hand, is deciding that stock is so cheap that I can buy it inexpensively. And when the market realizes what its true value is, I gain that. That's my value that I add in there. So it's two very different philosophies that are a constant undercurrent in your investments. And it's one of those things that we help our clients to understand, is where their exposure is, and making sure you're not leaning so far into one that you negate the potential of the other. I think that's the way of putting it.
Right.
All right, let's jump ahead. We're going to talk a little bit, speaking of valuations here. This is a little wonky here, Katie, but this is kind of the annualized and year-to-date growth from all these different sectors. We talk about value and growth. You can see growth averaging almost 15% per year over the last 10 years. Value, only 10.5. I mean, 10.5 is nothing to sneeze at, but it's been, vastly outstripped by growth. And then large beating small. So if you want to be the smartest person in the room over the last 10 years, you put all your money in large cap growth, but please don't do that. But then you see the year-to-date performance, and this is that change, that transition that we're wondering, is this the long-term trend? Growth down 28%, giving back some of that long-term record. Value holding up a little bit better. What do you make of this?
Honestly, I mean, that's you said, still looking at the historical averages, looking at year to date. The thing that jumps out to me more in this chart is the PE side of it, the price to earnings side of the chart. And we've been talking about this for a long time. When we were talking about this, year 2, 3 years back, saying, okay, we need to pay close attention to these PE ratios, because eventually there's a normalization, and it's going to be a matter of, are the companies going to earn their way out of it, or is the price going to come down? And we've seen, obviously, the prices have been coming down. So this chart down here in the corner, I don't know if you can see my pointer, maybe not. Can you see it?
Okay.
Okay. So this chart down here in the corner, this lets us know what the current PE ratio is as a percent of the 20-year average. This is where we have been saying, all right, eventually that has to normalize, and we're seeing that normalization. So it actually, from my perspective, this gives me a little bit of comfort. Not that I like to see the markets down, but I like to see that things are falling in line to where they should be. We're not at this place where there's, because once you get to be so overvalued, there's a lot of speculation built in, and we're starting, a lot of that speculation has now been kind of chopped off.
Right. It kind of comes back to, if we were talking about your financial plan and I told you that something was unsustainable, it would probably send alarm bells off in your mind, right? So some of these numbers here from that large growth, that was really looking unsustainable for a period of time. So that correction is probably, you're right, it's a very necessary thing. All right, last couple of slides here. Sentiment. I love this chart, Katie, because it just really speaks to the last 50 years or so and just how bleak the outlook is, but what the implications are for forward returns. We talk about it's always darkest before the dawn. That's what this is really sharing here. And that sentiment number is really low.
It's the lowest it's ever been since the University of Michigan has started to track this. It is very low. But the crazy thing is that investor behavior is not as low. That's where we're still seeing spending. We're still seeing, travel, new homes being purchased, all of that stuff. And it's interesting. I was listening to Lizanne Saunders last week. Schwab was doing one of their updates for their advisors, and she had made the point. Yes, sentiment is really low, and we can see, this is looking at returns 12 months after you hit these low points, and there have been positive market returns after each of these low points, and well into the double digits. Hopefully, we won't get much lower, but there has to be some sort of reconciliation between the consumer behavior and the consumer sentiment. And so from that standpoint, I just want to be patient with this and see that, that there might be a little bit further to go before those two areas start to reconcile, and then we get that snapback. I don't know.
Right. So a couple of questions here popping up, and we'll keep going here for a minute because I think we've got some good things coming here. One question is, if unemployment is so low and people are so short of workers, we hear anecdotally just everywhere you go, people are looking for workers and can't hire enough people, and staffing issues. Is the unemployment rate true? Is that 3.9% or sub 4% employment rate true? That's the distinction between the unemployment rate and workforce participation rate. So the unemployment rate is based on the number of people looking for jobs. But if you're not looking for work, if you've left the workforce, then you're not included in that number. So it reduces the denominator. And then that's part of the issue. Is I just kind of pulled up a stat on the labor force participation rate. So through June of this year, it's sitting at 62%. 20 years ago, it was at 67%. That's a lot, and it's as low as it's been. It's even compared to where it was, back so many years ago. It's lower than it's been any time since the 80s, going back. That means there's just fewer people out there looking for jobs, and the unemployment rate isn't the figure to look for in that. It's the participation rate. So there's just fewer people out there, and that is an issue. And you started to see some stories about people who may have left the workforce coming back in now, maybe lured in by higher wages or just the economic challenges or whatever it might be. So I think the unemployment rate is accurate. It's just the participation rate is much lower than it used to be. Another question, this kind of comes back to what you were talking about, Katie. If sentiment is so low, why are people spending so much? I personally, I think that just speaks to, it's the nature of the last few years. there's so many things that just don't make sense put on top of each other. How we are doing certain things and not others, spending money when we're having economic challenges. I think it's a little bit of catching up, probably. I think you talked about that migration from spending on products to spending on services. How many people do you know who are traveling a lot right now, or just using this time to get where they're playing your graduation parties that are 2 years overdue, weddings that are 2 years overdue, all of those things? I think people are still playing catch up. The question is what that does for their personal balance sheet.
I agree. I think that's part of it. I also think sentiment dropped so swiftly because let's take, the drop and the quick recovery in 2020 out of it for just a minute. Because we still had a really strong year in 2020 and 2021. Like, the market was so strong for so long, and this bull market so extended that people have just been waiting for a shoe to drop. And so as soon as there were, some indications of that, I think immediately they're like, okay, this is it. And the news feeds don't help. They feed right into that fear. So I see where things have dropped off, but then also coming off of that bull market, I think there are a lot of people that are sitting there saying, I'm okay. I just worry about the guy next to me. Do you know what I mean? So their behavior is not changing much because they feel okay, but they're like, oh my gosh, the world's falling apart.
Well,
I'm sorry, I shouldn't laugh at that. I didn't mean to, but
no, but that's kind of the snarky definition of a recession, is when your neighbor loses his job, right? That's people. It matters what you see kind of proximate to you, and what's happening next door. There's a question here about what the savings rate looks like. We like that number. We've been watching that for 2 years now, because the savings rate, was just trying to find the historical average here. The long-term average for the personal savings rate is 8.8% going back over about 60 years. It's 5.6% right now as of the last print. Pre-pandemic, if you go back to 2019, it was sitting at about 7%. It spiked up to 26%, more than tripled, because of stimulus, lack of spending, just people accumulating cash. But that has since been spent down. I don't know the exact correlation. There are going to be books written about this time period for generations. But I think a lot of the product-related inflation has something to do with that accumulated savings of 2020 all being pushed out through the economy. But now we've seen the savings rate back down pretty far below where it was pre-pandemic. So people have spent away that surplus, and we'll see how that shows up for longer term inflation, some of those numbers.
yeah. And I will say, and I think I've said this before, one of my concerns is that we've set some habits that may not be good habits going forward, and that people, when that savings rate was so high and they started to get catch up and said, I'm going to live for myself, for my family right now. We're going to spend it. We're going to do all these great things. That the spending, I am a little concerned that the spending may get too lofty. And that goes back to that consumer behavior then. That might be part of that reconciliation where all of a sudden they look up and say, okay, I can't sustain this anymore. And that behavior changes. But I don't know what it's going to take to get to that point.
Yeah, I think this is really, the last 2 years have really been a time for very principled investing. Like, you've got to have a lot of strong muscle to insulate yourself from the temptations of last year and the fears of this year. Those things have been just going like crazy. And that's why we do these sessions, because there are certain core principles. We're not telling you to dive out of growth and dive into value, but understand the dynamics that are at play, and then figure out how they impact you. So these are all really good questions. If there's anything else, just let us know. We want to touch on, just speaking of core principles, just a couple more thoughts here as we close out. I love this chart, spending time in the markets, not timing them. So this chart shows over 1, 5, 10, and 15-year periods. The areas of blue are U.S. stock performance that have been positive. So 75% of the 1-year periods have been positive. 89% of 5-year periods. And you got 100% of all 15-year periods have been positive. So I think you talk a lot about this, time horizons. Have you ever met someone with a 1-year time horizon?
Yeah.
I've yet to meet that person.
Or even a 5-year. I mean, from a planning standpoint, nobody ever plans to spend everything down within 5 years. And at 5 years, you're almost at 90%. And this is looking at the stock market. This is not a balanced portfolio or have, any component of fixed income, which historically provides more stability. And even this year on a relative basis provides more stability.
Yeah.
So
Yeah. These are things that my personal opinion is this should be run before every commercial on financial media. Park this right up front before you cut away to the scenes of people walking on a beach, investing in high cost mutual funds. Let's show this chart. I just think it would be that's my dose of wisdom for the industry for the day. All right, one last thing we'll touch on here. We've seen this before, the Callan chart, the periodic table of investments. This quilt is a chart of all the things you could invest in: stocks, bonds, large, small, domestic, international, ranked by performance. So the top row is the best performing asset class year by year, going back 20 years. The challenge with this is spot the pattern. Katie, you found the pattern in this, right?
did I?
I think you squinted. There it was. It's like one of those things from the early 90s, like a picture of whales shows up if you squint really tight and it's just magically appears.
Yeah.
So no, there is no pattern to this. You have large cap domestic stocks in the blue that have done really well over the last 7 to 10 years. If we showed this chart for this year, they're going to be down on this lower side of the spectrum here, and you're going to see bonds having their day. You're going to see something like cash, which has been the worst performing asset class, the most, 7 times in the last 20 years. You're going to see cash up at the top this year, an anomaly. So, which has never happened in the last 20 years. So when you're diversified, ideally, you have combinations of all these things, and you're not placing heavy bets on one doing another. What does this remind you of? Like when you see this chart, Katie, what do you pull out of it? Like I always see something new when I take a look at this.
Like you said, there are no patterns, but there are things to pick up on. I mean, stocks continue to be, a stronger investment for the long term. So you typically see like large cap stocks in the top half of this chart. Cash, it erodes over time. It just does. And so that typically lands in the bottom half of the chart. That's not to say there's not a place for cash. There absolutely is. And we do talk about, how important it is to have those emergency reserves, how important it is to know what your short-term needs are versus your midterm and long-term needs, and make sure that you're invested appropriately. But if we're looking at something longer term, then yes, build in at least a component of the risk. Just make sure it's at the right level. And if you need something short-term, yes, hold on to that cash and shorter-term bonds and those types of things. So it's, yeah,
absolutely true. So, all right. Well, listen, we appreciate all of you joining us this morning. We ran a little long, but I think there's some good questions and a lot to cover in a really what's been a challenging year so far. But if you have any specific questions or would like to follow up on anything we discussed this morning, feel free to reach out to either Katie or myself. We're happy to talk anytime and explore any concepts and hopefully educate you along the way. So we're here to raise your awareness of the investing environment, and hope everyone has a great summer. Wish you all the best, and we'll catch up with you again next quarter.
Take care.